This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his Wall Street veteran and good friend of the channel, Taylor from Life Goal Investments. How you doing, buddy?
What is happening? What's happening? Thanks for having me.
Absolutely, man. Missed you for a week. Sometimes you got to do what you got to do, so I understand. Thank you for coming back this week. I've just got to ask. I have never seen a time in my 30 years where a macro econ guy, myself, and Wall Street, generically speaking, you, have disagreed so violently. Now, what am I talking about? I'm talking about Jerome Powell's 2 p.m. or 2:30 p.m. press conference where he delivered 75 basis and then his, hour of Q&A. Wall Street, you in this example, heard Fed pivot. I did not hear that. What the hell is going on? Why is there this disagreement from econ macro guy and Wall Street? Because Wall Street said, oh, cool, Dove, Fed pivot in September, off to the races, risk on. I don't get it.
Yeah. Hey, it was an interesting divergence between his prepared remarks and his off-the-cuff remarks. His prepared remarks were not dovish, in my opinion.
No, they
were actually hawkish. They
Agreed.
were saying that we need to control inflation, enemy of the state #1, et cetera, et cetera.
Yeah.
And then the other hand, I do think there was some softening of the language on the other end in his off-the-cuff remarks, which are never off the cuff. They prepare them as well. But he said in one way, shape, or form that it may be time to start lightening up on the rate hikes. And you saw, again, the market took off like a rocket ship, right? And I mean, for the month of July, the market had been on a pretty good tear, a really good tear. July wound up being the best month since November of 2020 for the S&P. But to your point, that exacerbated the upside movement, and it's continuing through today. And it's funny because you look at the one side and the stock market is absolutely ripping, and you look at the other side and you would think bonds are softening, selling off. No, bonds are rallying too. So it's like, which diverging path do you actually believe in at this point? So give your side. I want to hear what your take on this whole thing was.
So I guess I have a couple of thoughts. So I've actually listened to his press conference twice. Right. Once live. And then I'm like,
you're a machine.
I'm like, I must have missed something, because when I see the S&P up 4% or 4.5% in 2 days into what I thought was it leaned hawkish. I wanted nasty talons, beak, didn't get it clearly. But the market reacted like it's a big, cute white dove. I'm like, shoot, I missed something. I got to listen to it again. So near as I can tell, there are 2 points that I think he lost. Basically 2 points. He gave the market what they wanted, and then the market took off from there, right? I heard what I want. I'm good to go. 1. And he said this twice. We have reached neutral. First off, I screamed out loud, he's a complete ass and he's wrong. And then we get Larry Summers and Neil Kashkari and all these other folks coming out after going, like, what are you talking about, idiot? CPI is 9.1. How the hell can you be neutral at 2.5? What are you smoking? So that
maybe our definitions are too different.
What language are you speaking? Right. So, but he didn't say it once, like he could go back and go, oh, I misspoke. He said it twice.
Just for context, though, let's add a little context here. Neutral essentially means that Fed funds rate is equivalent to inflation. That's at least the traditional.
No, absolutely. It's basically, I'm not restrictive and I'm not accommodative.
Right.
You're not. Come on. Are you kidding me? 2.5 in a 9.1 world, and you're saying you're neutral. So, but again, macro guy, me, you're a moron. Wall Street. Oh, we got what we wanted. It's transitory. This 9.1 is going to melt away. Kathy Wood and deflation and bullwhip effect and all this shit. It's just going to magically be better by Halloween. And good. That's what that's what the market heard, my opinion.
No, it absolutely is. And when you look at, so we talk a lot about this on this show, or at least I do, 5-year forward inflation. So where the market expects inflation to be 5 years out from now. And I generally think that the market gets it better than the Fed does. But that said, market expectations for inflation 5 years out from now are at 2.33 to be exact. I just looked at them this morning. That is really aggressive steep cliff that they need to come off. Now, granted, it's a 5-year period of time. I totally get that, but that's a really steep cliff for them to get from 9.1 where they're at right now to 2.33. Do I think inflation's coming down? Yes, I've been very vocal about that.
Yeah.
I was early on that, admittedly. But that is a very aggressive fall off in inflation. I think the only way that we get there is the market saying a recession's coming. And that's what the bond market's saying, by the way, as stocks rally on the other end. It's like, what the heck is going on?
I just checked this morning. Not only we have yield curve inversion, it's getting steeper. We have the 10-year note crashing again.
Yep, it's below 2.6. Just below 2.6. That's a big move.
Yeah, so it peaked at 3.49. Not like I look at this stuff all the time. Now it's down almost a full point, and it's down a full point, and the Fed is raised 150 basis points. I don't get it. What the hell?
It's the market telling you that there's a recession coming. Again, we talk a lot about this, but the front end of the curve is going to be responsive to the Fed. So you've seen the 2-year, the 2 years had a little bit of a weird movement. That's the one that I look at that should be responsive to what the Fed's doing. It's kind of just been kicking around, bouncing up and down. Today, the 2-year, I think, is up a little bit.
Dude, the 3 month. We're getting dangerously close. The 3 months at 2.396 and the 10s it just went to 2.61. So we're 21, 22 basis points away from 3 month inverting.
Yeah.
That's not good.
That's a scary sign. And you see the 2 to 10 year spread right now at negative 30 basis points ish.
Yeah.
That's the most inversion you've seen since 2000. So the market is at least telling you they're confident that a recession's coming in the bond market, but the stock market's ripping on the other side of this Fed dovish pivot, as we're calling it.
Yeah. So in video number 3, we're going to tackle a bear market bounce or whatnot. But so it's crazy. So there was 2 points I talked about. That was the first one. The second one, the second statement, I actually caught this live and I'm like, that's technically correct, but you shouldn't have said it. And that was when he basically acknowledged the rate of increases will eventually slow down. I'm like, no shit, idiot. You can't raise rates at 75 basis points forever. So that's technically correct. But you just gave Wall Street permission to rip because they've been waiting for you to pivot, you idiot. Why the hell
you're not going to raise
that?
75 bips in perpetuity?
Yeah.
Thanks.
I caught that one live and I'm like, oh, that's going to hurt. And it did.
Yeah. Oh, no, it did, because look at the market rip. I mean, it's interesting. I looked also this morning prior to the call, because I know we always talk about this. The expectation for rate hikes are now 25 at the next meeting, 25 at the next meeting, 25 at the next meeting. So another 75 basis points between now and the end of the year in 25 basis point increments across the 3 meetings that we have. And then the interesting move from there is that the market expects them to begin cutting after the first meeting of 2023. So it's like, again,
raise, pause, cut.
Correct. That's exactly what the market's expecting right now. They're just playing. Yeah, I mean, we saw this in 2018, right? 2018, they raised in December, and then they cut in, I think it was June or July, I guess it was, of 2019. So it's not like them to not have a change of course. And again, the data dependency, in my opinion, the data right now, and Michael, you and I have been saying this now for 4 or 5 months, whatever, that a recession is coming. The data dependency, if a recession comes, like, they're going to have to move off of this direction that they're taking at this point.
Yeah. So again, we'll kind of close on this episode again. I guess the last thing to talk about. So you and I both know that his off the cuff answers aren't really as off the cuff. They're generally prepared. There's talking points he wants to hit again and again. Right. So it's not as random. Do you think because I actually just interviewed somebody who actually said Jerome Powell knew exactly what he was doing. He was trying to give Wall Street one more out before the stock market tanks. Do you believe in that kind of conspiracy theory?
No, I don't. But that being said, I do know that he didn't. Those weren't mistakes. I don't think that was something that he was like, oh, and he does know that the market's going to rally off of that. So they can't be truthful, in my opinion, with what they're saying about the economy. They just keep saying the economy is good. And every economic data point out there essentially is telling us the economy is not that good. It's slowing. Growth is moving downwards. I don't know what you can look at right now and say strikingly that this is the only positive that is strikingly positive is unemployment, right?
Yeah.
Jobs are plentiful out there. I think that the job openings numbers that we continue to see
Bogus,
though are
yeah.
inflated. There are people out there with a job posting that says, hey, like if the perfect ideal candidate comes along at a fair price, we'll take them. Like, again, no shit. Like,
Yeah,
of course you will. And therefore you have a job opening for a perfect employee when they come around. But that's not a real job opening that you're looking to fill.
So last question, I asked my last guest this question. I wanted to ask you as well. Let's assume you could give Jerome Powell true serum or alcohol or whatever his vice is, you and him in a room, one-on-one, no microphones, no recordings. Do you think he would admit over the weekend that he was pissed off that the stock market ripped so much?
It was ripping going into it. So if those aren't, mistaken comments, I don't think he could have foreseen it going any other way. If you say that, the restrictive policy was one of the reasons, and something I've said many times on this show with you is don't fight the Fed.
Yeah.
If that is what was causing some of the downside in the market, he has to know that when he pulls that sheet out and says, okay, we might actually revert course at some point here, that it has to go higher.
Yeah. I hope. I would hope that he would admit that he was disappointed, because again, you do have the stock market rips, but the bond market goes the other way. I've just never seen such a time of a macro economy and the stock market disagree so much. So Taylor, where can people find you?
Yeah, follow us at Life Goal Investments. Like a lot of this conversation that we just had right here about the stock and the bond market diverting, like that was a post we did on Friday in 30 seconds or 60 seconds. I mean, it's a little shorter. You don't get as much detail, but nonetheless, you get a feel of what the heck is going on out there. So again, at Life Goal Investments. Thanks,
do
Michael.
yourself a favor, follow him. I do on IG. It's wonderful stuff. Thanks, Taylor.
Appreciate it.